Yeah, it looks like their markets have opened up quite well in terms of Bitcoin. Bitcoin definitely is shown quite the resilience. It's up 1,800. Yeah, Bitcoin is definitely 2,200. Wow. Um, Looks like their other markets have opened up pretty well. Gold came off a little bit. E-mini ES is up. A lot of things are up. See what we got in our inventory. And there's some trades I have to close due to there's a couple of trades I have to close due to the fact that you got an election coming, and I don't want to be in this trade too long. I've already rolled it once, and I've rolled it once. Let's see. Let's just get out of it. IWM, because I've been rolling and rolling that, and the more I roll, that means that it's still a little too volatile. So let's get the window up. And IWM, I don't want to be in that trade. Even though it's a December trade, I want to, because I anticipate a lot more volatility coming in from their so-called election. I would rather put that trade on after their quote unquote election. I'd rather put it on later and not be in this trade. So we'll see if we could get out of that. We'll see if we can get out of IWM. And that one's definitely gone up. Yeah, I anticipate a lot more volatility. Let's see what we got here. We're trying to get out. Let me get rid of this. Of the IWM trade. Everything else is still, our deltas are even though IWM is even deltas. I like the deltas. Problem with that is even with our deltas being even, I don't like the fact that I already rolled it once. Because the more and more you start rolling stuff, the more and more it's telling you that it's not going to die down. And you got this quote unquote election right around the corner. And so there's going to be volatility regardless. So I'd rather get out of this at break even and redeploy it later. Do the break even, redeploy it, and then get in the trade at a higher volatility point. Because I anticipate, although it may never happen. What's up there, Brother Will? I anticipate that more than likely, the day after that quote unquote election, you're going to see a market drop like you've never seen before. Especially if Trump gets in, because you're seeing the uncertainty of, after Trump gets in, it may spike right after the election. Trump will win, markets will go up, and then the next day you're going to see a crash because of the fact that, it's just the selling of a lot of positions. And I don't think folks want to continue to be in those positions because of it. So they're going to more like redeploy the capital, seeing exactly how things are going to work out. So that's what I'm kind of anticipating. I'm trying to get out of IWM, see if Tasty Trade will fill it. So I'm getting out of there at kind of break even, just paying commissions. Yeah, I just want to get out of that trade and redo it, because anytime I have to roll, that means that even though the Tasty guys like doing that, I don't like chasing. It's kind of a combination between. I hear Theo Trade say it a lot. They don't do a lot of adjustments like that, because it's like if you wreck a car, you're not going to try to go ahead and it's like, okay, I wrecked this car. It's been trashed. It's totaled. Now I want to fix that car. That's kind of like a trade. A lot of folks try to fix a wrecked trade instead of just going in and saying, look, let me see what I can do to minimize the damage. So therefore, maybe I could sell the muffler and get some money back. That's the only kind of adjustments that I look at. Like I said, every trade I get into, the first thing I know is I'm going to adjust it one way or the other. That's just the nature of this business. You always adjust. Let's see where E-mini is at. E-mini was up 33 earlier, so it's kind of pulling back. So today's more than likely going to be a flat day, unless something crazy happens. You got inflation numbers coming out this week. You got a lot of things that are basically election centered, because inflation is definitely an election centered thing. So a lot of positions are going to, Brother Will, are going to go around and round. And so I'm basically looking. So let's look at E-mini S&P. More than likely, the number you see right now is going to be more than likely what you're going to see later. Again, nothing's guaranteed. Let's look at VIX, the cost of fear. VIX is dropping, okay, which is, that's kind of what you would expect, because of the fact that markets go up, VIX goes down. Let's look at the cost of money. Cost of money is going up a little bit, probably reflecting those inflation numbers. So the cost of money is going up. See if we can get filled in this thing. Nope. Okay. I just want to get out of IWM. Plus, I've only got 13 days to go on this. IWM. No, I got 53 days. It's 13 days to go on the EEM calendar. That's the one I'm thinking of. Or 18 days of that calendar. So I'm not going to freak too much on that. I forgot I had that EEM calendar there. But even though it's got a lot of time. It's just I rolled it so much with a lot of time lengths. Even though that EWM's is down, their volatility is down. When I have to roll it that much and I still have that much time in, that's telling me that this thing is more than likely not going to settle down. So I don't want to take the chance. So anyways, we looked at our inventory of what we got. Let's look at the inventory of what never filled to see if there's a second chance of getting in those trades. The ones that never filled. One was spiders, the spiders, SPY. And I was getting into that. It was a calendar trade, just a regular calendar trade. And I wanted to get in that. And I was trying to get in that at 102. It's now trading at 106. So, markets are just kind of stabilized. My justification for that is to more than likely, again, that volatility coming in, getting more volatile. And I'll wait later on to put this one on. I got to hand it to, who was it who had a trade? He has a diagonal trade, which is kind of like a calendar, a diagonal trade, which is basically a vertical spread and a calendar at the same time. So, but he's anticipating a market drop. I'm just anticipating more volatility, whichever way it goes. I'm just thinking, hey, this thing is more than likely it's gonna spike one way or the other, but it's gonna go up in value. So I'm looking at maybe spending 102 and buying it back at 150, that kind of thing. Spend $1 or $2 and buy it back at $1.50. Not to say that's going to happen, but that's what my anticipation is. Like if this thing again, I was looking to put it on for November 8th. So between now and November 8th, let's look at that. I was only going to be in this trade just a few days. So if I stayed in this trade till say November 4th, because I anticipate a lot of volatility, November 4th, or like I said, even back then, November 1st, if we stayed into this, it is expected to move $8 one way or the other between now and November 1st. $8. So if they expect it to move $8, then we're looking at this thing going between 580 to maybe toward the 560 range between now and then, and analyzing this thing, again, let's say $10 because I'm gonna overstate it. So from, if this thing moves $10 one way or the other, this analysis, they expect this thing to move $8 again between now and then. So because there's our expected move between now and November 1st, they're saying that chances are it'll be an $8 move. Again, you got an election. My thing is like, I don't care. I'm gonna say $10. So if this thing has a probability of moving $10 between now and then, again, we don't want to stay in this thing till November 15th. We just want to stay in a certain amount of time. So if it's going to be there, then what would happen if this price goes up to 591? Okay, if the price goes up to 591, theoretical, okay, and if it goes up, volatility usually crushes when it goes up. Theoretically, let's see if we use price, don't use price per implied IVs. Theoretically, chances are you'd be, it's like, I'd say, I won't say the entire, because that's, I'm using the implied volatility per contract. Chances are those contracts are going to change implied volatility, because you're out of the money would more than likely hold on to its implied volatility, and the other one would kind of go down. But if I don't use that, you might be up some money. You might be up a little bit of money. I mean, just looking at that, if implied volatility, the whole thing goes down. Right now it's at 21.5. Say it goes down, to if it goes down 2%, no, to 16, excuse me. If it goes 16, then then you can lose theoretically. Not to say, that it will. If it goes up 2%, then you're going to be up. So it's definitely a theoretical. It is a crapshoot. But my thing is I don't want to be in that long. And that's okay, let's go to the effective date of November 1st. Okay, let's go to the November 1st. Wait, that's 10-1. Let's go to 11-1. November 1st. And see what's going to happen. Let's reset implied volatility. Say if it goes up to 591, which is $10, and implied volatility goes up, you'd be doing, theoretically, you'd be okay. Again, that's theoretical price. If it goes down to 581 or 571, because this is 581 now, okay, 571, implied volatility goes up, and that's a big, that's a 2% rise in implied volatility. Not saying it won't, because that could easily happen. Then, theoretically, you might be doing okay. If it goes down, then theoretically, you're not going to be doing as well. Should it go down? And that's what my anticipation is this thing could possibly drop by November 1st, $10. And that's kind of my, my outlook on this, in terms of this particular quote unquote trade. Implied volatility used per contract IVs instead of the whole thing. And so if we go to November 1st, all things being equal, November 1st, if the market stays where it's at, you make a little bit of cash, not much, theoretically. I'm saying theoretically. And if both, if market goes down to 571, then you'll be down. If it goes to 591, and that's if everything, all things being equal, you'd be up just slightly, a little bit of money. Now, here's the thing: if we go per contract implied volatilities, if the lower implied volatility, the one that on the 15th, if that held its implied volatility and the other one goes in, say 2%, you'd be doing pretty good. Should the market rise, and if the market falls, you'd still be doing pretty good. All things being equal, if it just remains where it's at, you'd be doing great. Because normally the implied volatility of the front month will go down, and the back month may retain a little bit because it is, a little bit further out in time. Now, saying, and if the implied volatility goes up on the front month, which is more than likely going to happen, as it gets closer to November elections, then you'll be down a little bit, which means you're going to have to manage to get yourself out. Should the market fall, then you're going to be down quite a bit. Should the market go up $10, you'll definitely be down. That's if the implied volatility rises in the front month and doesn't rise in the back month. Chances are both of them will rise because of the fact that, of course, you got an election. So, I mean, that's just the nature of the game. So I like to look at these scenarios. Again, options is about buying and selling implied volatility. So I like to see those options. I like to see the ability. This could be, again, a vertical spread, and we'll look at a vertical just to see, which means that you're more directional. Because it's an election, you may looking at more of a directional scenario. Let me see if we could get out of that IWN trade yet. No, is still vacillating where it wants to feel. So again, I don't want to stay in that too long, even though I've got 53 days. I'm looking at the fact that this election is going to make things more volatile, and it's going to move it around quite a bit. I'm almost thinking the same thing with my FXI strangle. That when Trump gets in office, that will more than likely fall and get more volatile because it's a Chinese ETF. And if Trump gets in, you're going to have problems with Chinese securities. Because remember, when Biden got in, he destroyed the Russian securities. That's why there's no Russian trading. When Trump gets in, it would be more than likely that he might not go to the same lengths as destroying those, but those securities that are based upon China will be affected, and not in a good way. Okay, we tried twice with TLT, and that never got filled. So we'll try the last time on TLT and see what pricing is. We were asking $9 in credit. No, we were asking $13 in credit. Now it's down to $9. So chances are that trade TLT is going up a penny. Chances are that's going to be off the table. That is bonds, because I was thinking of things getting more bullish in bonds. No, that basically ranged. It really didn't do much since we were trying to get in. That's telling you it wants to go back down. If you're looking at it right now, it's looking like it's more than likely going to go back down, which means the cost of money is going up. Implied volatility is going up. When you're doing a butterfly, you want the implied volatility to go back down. So chances are that'll be one to kind of sit on. If we go to the actual trade and analyze what we're looking at, remember we wanted to keep him on the hill. If we're looking at this, let me just see how that looks. Yeah, I mean, it's kind of still in the wheelhouse of possible trade. We'll try to get 12 cents or $12, i.e. 12 cents of credit. Our theory is between now and December that this thing will either fall right in the middle and give us $112 of profit with an possible $88 loss, which I don't mind because, theoretical is I mean, we're not going to go for the whole $88 loss. We're going to get out should it go beyond our shorts or our strikes, which would be, we'd probably be losing it very most. Should it get past this this triangle, we would be losing at the very most 22 cents. And I would never let it go any further than that, because that's our theory, is like it won't get down there. Why? 86 is like the point of no return. 86 and 86 in terms of delta for that December contract. The 86, where's our deltas at? If we got into this trade, that would be down here at around 16 deltas, which is what we theoretically. So we're gonna put this one back on. It pays you only 18 cents, but it's okay. 18 cents of theta a day. You are along a little bit of delta. Gamma's not going to hurt you as much. You've got a probability of profit of 82%. That is more than likely, which means why? Because you're getting that credit. You're going to keep that credit. This is a really a lotto ticket type of trade, but we're going to put it on. And I have it at 12 cents credit. I may have to work back to like 11 cents. Again, this is a speculative trade, kind of like the diagonal. It's not the calendar. The calendar is, for me, it's only volatility speculative. I just want to make money on volatility going up. I could care less whatever happens after that. I just want to see volatility go up. So we're going to put that one back on, that TLT butterfly. I'm slightly bullish, but I'm more thinking it'll fall and I want to be protected should it rise. I want to be very, very protected should volatility go through the roof. So yeah, so we got that going on. We got our TLT. So in terms of new trades, okay, we checked the inventory. So what was the other butterfly? There was another one that I was looking at, that GDX. Let's just take a look at that inventory. Because the only reason I'm not in these is it's a pricing issue. This one right here was another pricing issue. GDX fell a little bit, like 8 cents. So again, this is one of those pricing issues. I'm just trying to ask too much for it. But if the market goes where where I'd like it to, then I'll get filled on the trade. This particular one is a little bit more dangerous because it has been falling, and it's damn near inside of our triangle. And I never really like to take trades that are inside the triangle. It's getting close to the triangle. That triangle right there, you will get a little bit more credit for it, which is cool. You are definitely getting paid for it. But then again, if it gets into the bottom part of the triangle, you're going to really have to, your theoretical, you're down a little bit. It's a 150, 150. So it's before we had more possibility of profit. Now you don't, because it's a coin flip, and I don't like coin flip directional plays, because those usually, unless I'm using my holy grail, I don't like coin flip directional plays, because the coin flip directional plays are I'd like to put the probabilities more in my favor. You do have an 86% chance that it will give you 50%, and you have the probability of profit of making at least a penny or more is still 70%. That's good. But then again, it's like I always get into a trade knowing I'm gonna have to manage it. So the fact that GDX has been falling a little bit, if you see that, it's been falling. It's barely ranging today, but it's definitely been falling since I really tried to put this trade on. Chances are that and this is a 53-day trade. Not to say gold is going to go back up. Again, you got an election, but look at our deltas. Our deltas back. We were our short strike. I like to have the short strike at least one delta right there. That 16 delta with 17 is where our fence is, or the very last fence. I want to bring these down a little bit and see what kind of price things are going to be, because I want this to be within that fence. Okay, we're getting much less credit. Only a 131 profit with a max loss of 169. So, the profit to loss is not necessarily in our favor. Not like I'd like it. If we did this, we're gonna even take we'll get a better profit to loss scenario. But the thing is, we get much less credit, much less credit for it. We're not getting paid for the risk. Right here, we're getting a little bit more for the risk, but not good enough on our. And then this is our if we moved our fence up and we tighten it up a little bit, we get more for our loss, but we're only getting a little bit of credit. And so in our deltas, we're a little bit more longer deltas. Whereas right here, we're going to be, if we move our entire thing, we're going to be a lot less longer deltas, but we're not going to get paid for it. This is really, really highly speculative. We get, max profit to max loss is better, but the chances are this will be a scratch trade unless gold really, really falls down to the 37. And it has to be there on our. It has to go all the way down to 37 on expiration, which it could happen. I mean, this is a 53-day trade. It could happen right down there. If it pins down there, which is a very small probability that it will pin. I mean, it might be okay. But again, like I said, I always get into a trade knowing I'm going to have to adjust it. This right here, greater loss, less profit. Okay, and your longer deltas. You got more deltas. Which makes sense because your short strike is a lot further away. Right here, you get you get more credit, but you get more credit, but then again, I mean, you got a theta of 27 cents a day. You got a theta. This doubles your theta. This will, and I'll show you what I mean. This will actually give you the same amount of theta per day, less credit, but the greater amount of theta. You're only getting 5 cents more credit. That's a 116.84 in terms of profit and loss. Here you got 111.89. So, I mean, the efficiency of markets is just telling you. I mean, it's 6 dozen one, half a dozen the other. You could either get closer to the fire with your short strike at 23. I mean, with your short strike at 29, or you could get a little bit a ways from the fire. So it's it's the 6 dozen one, half a dozen the other. Profit and loss here is 111.89, whereas you're going to get paid for being next to the fire of having 117.83. But I mean, it's negligible. 6 cents either way. And that 6 cents is made up in this credit that you're going to get right here. My thing is, how close, I mean, if I'm going to have to manage this, again, everything that you get into, you're going to have to manage. You cannot avoid any trade without having to manage it. So we go to our analysis. If this thing falls, and again, we don't want to be in the entire time, but the thing is, you're going to have to hold it longer. This is a 53-day trade, so which is December 20th. So that means we're going to have to hold this in order to see something happen. We're going to have to hold this, say, to the middle of November, because you're going to want to be out, say, November 21st. What is going to happen theoretically should you stay in this trade? November 21st, all things being equal, if it doesn't move, if it doesn't do anything, and this trade just continues where it's at, all things being equal, then you basically be treading water. Now, if this thing drops from 41, because this is 41, and it drops to like 38, because remember 37 is where we is, or 30, let's see, it's 37. That was before. Now 38 is where we're scared, because we're at that 23 delta. That's the delta after a short strike. If this thing falls to 38, you're going to be down. You're going to be down. That's all things being equal, and volatility doesn't change. If volatility goes up, which with GDX, when it falls, volatility normally goes down. So if volatility goes down 2%, it would have to go down a lot longer before you start, reaping profits. It has to really, really, because in that 38 wheelhouse, you're going to be getting hurt. Again, you have to hold this much longer. If volatility goes up, it's worse. So you're still not making a profit theoretically. If it should do that, you're not going to be making a profit. And that's what will happen if it gets to that point at that time. If it goes up, then it's a free trade. But if it goes down into that 38 in the middle of November, you're going to be experiencing some heat, and knowing that, again, every trade that you get into, you're going to have to adjust. You're just going to have to know that you're going to incur more heat. Let's go a few days later and see if it goes down to 38. Theoretically going to be losing more should it go down. I'm not looking at should it go up. I always look at why am I looking at should it go down? Why? Because if it goes down, chances are, that's where you lose your trades. So this one is not necessarily one in the wheelhouse that I like. Let's move these strikes a little bit more. In terms of this strategy being a butterfly, I don't like it. It's 108.92. Even though you get paid 23 cents a day, you got to, the probability of profit is up there. You're only getting a little bit of credit. Again, it's a lotto ticket. But what would happen if it falls to 38? That's $3. If GDX falls $3 between now and Halloween, say you have a 3% drop, you're still going in volatility, you're going to be down. If you have a 3% rise in volatility, you're still going to be down in terms of profit, because this is one of those things you have to hold. You have to hold it in order to see a profit, especially if it goes down. And if it goes down to that 38, he's already in the middle of that triangle. And it normally never stays there, especially if it drops there early. It'll never stay there. So chances are, this particular trade is not necessarily one in terms of butterfly. I have to look at another strategy. Now, I really got a strangle in metals. I'm not looking at putting more strangles on, because even though we have a 69% IV rank, let's look at, let's reset all the analysis, reset all of this. Even though GDX has a very high IV rank, let's look at what it's been doing again the last few days. We're always going to look at, as if we were wanting to put that trade on today. Net change percentage, it's down. It doesn't have earnings. Look at the implied volatility rank, or implied volatility. It's been going down. The index has been going down. It's down 1% right now. So again, when it falls, it normally implied, when the price falls, implied volatility normally falls with it. IV index, let's see what the IV index is. So it's 36. It's okay. It's not like incredible. So in terms of this being one of those trades, I'm just kind of and I don't want to put more metals on right now, before this quote unquote inflation number coming out this week. So let's look at some new trades and see what might happen. Let's go to IV rank. Again, selling volatility first, and then we'll look at stuff that we can buy. Okay, I've never traded LQD, so I'm not going to try now. The LQD, another bond ETF, there's no reason. I mean, look at the IV index is like nothing. Even though the IV rank is through the roof, IV index cuts it down. It's only 11%. KRE, we were trying to get into that. And I was doing iron condors, but I don't want to put any more iron condors on, any more strangles on before this election. Anything that's non-directional, I'm kind of like, I'm not really enthused to putting it on before elections. XLF financials, IV index is still kind of low. Let's see, is that it? Did I have the right one? Oh, it just changed to me. XLF IV index is only 23, so it's still kind of low. I'm looking at that. Here's one I like. I've done this one before, and it's been really nice. This and American Airlines. I really like airlines. It's got a lot of contracts. This is Boeing, and Boeing's been on the floor. It's been destroyed this year. If you see what's been happening to Boeing can't get their stuff right. The only thing is implied volatility rank. It's been higher than it is now, which means I could probably sell it a little bit more. It has a possibility of moving $8. This would not be another iron condor because the price is at 151. It's a high price, for the particular type of stock that I would, for doing strangles. Because if I did a strangle in this, go out to 53 days. I did a strangle. Let's go down. Once this populates, we're going to get to our deltas. There we go. We go down 14 deltas. We'll go 20. I know I'm going to go 14 and see what 14 deltas, how much you would get paid for 14 deltas. 341, it's definitely nice. It's around a third. No, it's about 1/5. I mean, it's not terrible in terms of how much credit you would get, but I'm not wanting to tie up $1,500 worth of buying power just for a strangle. A little bit of slight skew to the upside. If I did this, I would go 20 deltas, and let's see, 20 deltas, and then go down maybe $10 in each one. Do a strangle. I mean, a synthetic strangle, which is an iron condor with wider strikes. So you have two. Again, you got your third the width of the strike, so that's good. You're tying up $700, but it's good. A third of the whistles and strikes. Gamma is almost nothing. Delta is almost nothing. 65% chance of getting, at least a penny at the end of the trade. Probability of getting 50% is 50% of the trade, which means you're going to get like 125 bucks between now and December. The probability of you doing that is 78%. The thing is I'm gonna keep this in the wheelhouse as a trade that I might want to get filled. I'll see what happens when markets move around. Let's look at that hill. We're a little bit off in the hill. We want the guy in the middle of the hill, but I'm not gonna freak on that. But the hill is there. Let's go and get rid of the C's per contract IVs. So being on the hill, it looks good. Again, first thing I know is if this thing moves, I have to adjust. So it moves down quite a bit. I'm gonna have to move that strike. It'll increase my buying power, by double, not double, about maybe 30, almost 40%. About 30%. I'm gonna have to pay more in buying power as I move this. If it went up to the upside, volatility would go down. But then again, if it went up to from 736, I would have to increase. I'm looking at spending, even though I'll get credit for it, the buying power will go up by 30%. And am I willing to hold on to something using that much buying power? So that's something I have to definitely kind of take into consideration. Let's look at American Airlines and see where that's at. We've got 48% IV index. That's good. IV rank is at 43. That's good. Implied volatility change is the problem being Boeing implied volatility change is up 0.2%. American Airlines has dropped over the last 5 days, and I think it's because of earnings. No, it's not earnings. The IV dropped 4%. I don't like that because I'm selling volatility, not buying it. If I even tried to trade it, unlike Boeing, if I did a December trade, did our strangle, this one we're at 10 deltas. We're going to go 21 because that's about as close as we could get. 21 on that and 20 over here. 55 at a 2. We're less than a quarter of what profit we could get. The other one was almost a third. It was over a third on the where it was a little over 1/5. This one is less than a quarter. It's like 1/20th. I mean 1/8. We would only, instead of 1/5, we'd be getting only 1/8 of the credit. And that's not good enough for me. I can't, I couldn't take that kind of a trade. Only getting 1/8 of the credit for a strangle. A lot of folks will get 1/10 and they don't mind that. Me, I mind it. And a lot of that we could tell if we look, even though there's a slight little bit skew to the upside. There's some skew to the upside without a doubt. There is some skew. Even with the skew to the upside, I couldn't do this as an iron condor because it's kind of hard to manage those with low price. If this thing moved, I would definitely have to, I'd be getting credit, but the buying power would go up quite a bit if I had to move this down. Yeah, see, I'd be getting just a little bit of credit on this, like 20 cents in credit if I had to move it. But it would definitely increase our buying power. It would definitely, I'm just looking at the skew and just seeing what would happen, and I look at that by looking at the distance between this and that is our skew. That tells me buying power, is going to cost us more as we move these strikes around. Even though it's a very low price stock, I just don't like the fact that I'm not getting a lot. And that's because implied volatility went down on American Airlines. It's gone down quite well on that particular stock. 4%. That's 4% of your money gone today because it went down. Let's see. I just want to get out of IWM. I got to get out of that. That IWM is like, that is like Even though, again, like I said, it's 53 days away. I just want to see if it'll feel me. Okay, it's going away from me because it's up $3. Not to say it won't go down or whatever. It's up $3. Yeah, IWM. I'm not gonna freak on it because I'm still. I mean, I could be better delta wise. Let's see, delta wise. Where am I at? Delta wise on this. I'm delta neutral, so I'm not freaking because I'm still delta neutral. It's just I want to get out because I don't want a volatility spike to take me out before that 53-day mark. I'd rather get in when it gets more volatile because you're in an election season. It's gonna get volatile. It's not a maybe, it's not a could, it's gonna. That's gonna happen. So I want to make sure that I'm out before that happens. Bank of America. No, that's Boeing. I thought I saw a BAC. Wells Fargo. Okay, 56.32. Wells Fargo. Let me just do this. I do want some financial exposure. That's why I was looking at that XLF at first, but I want financial exposure. Wells Fargo came down 1.1%, so I'm not freaking on the volatility, how far it's gone down. Ivy rank at 56. IB index at 32, so it's not terrible. Wells Fargo's not terrible. I just like the combination between the Ivy rank, IB index, 5-day change. I kind of like that. That's what I look for. Is those things, those three things right there make me kind of feel good. It's not like the do all say all, but at least I might be able to find some credit on this. Again, selling volatility is what I do first. 53. Let's go to 21 deltas. Go here at 17 deltas. Outside of this expected move. They expected to move $4 between now and December. I'm gonna make that 8 because we're in an election year. You're getting 148 out of 775. It's not good enough for me. I would have to do an iron condor because I'm not getting enough credit there. And normally when you have to do that, you're not going to get enough on the condor as well. So let's see if we go with the $5 fence. Well, there is no $5 fence. If we go down to 70, we'll go to 75 and there's no volume. Remember, volume is king. There's no volume. Even though we're getting one with the width of the strikes, there's no volume here on Wells Fargo. Look at that, 0 contracts, 5 contracts. So Wells Fargo's off the table for an iron condor. I do like Wells Fargo in terms of if we got those fills, but chances are, problem is you're already, your deltas and your gamma. And think of that as $8. Every dollar that Wells Fargo moves, you're going to lose $8. Wells Fargo has a probability of moving at least $1, an average of $1. A lot of that, and I say the last 21 days, a lot of that are these gaps. So I'm saying Wells Fargo can move at least $1. It's already 91 cents. So the average that is in 8 days is $1. So you would lose $8. So that's what I'd be looking at in terms of Wells Fargo. Trade wise, let's look at the mountain. Okay, let's look at what the mountain looks like with this guy. There is a slight, very small skew to the upside. But look at that mountain. There's a lot of, the mountain looks good over here, but if it goes against us, we'd be down 43, we'd be down $32 in a heartbeat. Should it go against us? Remember, this thing can easily move $1 a day because that's the average in the last 21 days. And if it went to our other short strike, we'd be down $74. If we're only getting $1.31 in credit and this thing hits our short strikes, we'd be down over half. In other words, we'd be down in terms of buying power, over 1/3 of the buying power overnight. I don't like that. Even if it moves, I'd have to readjust, which means I'm adding much more buying power. If I had to adjust this and get $2 of credit, buying power would go up to 542. We would be, chances are we would definitely be getting, we wouldn't be making enough, is the juice worth the squeeze? Should this thing go against us? Because that's the first thing I say is if it goes against us, I would have to move it. I'd have to move this instantly to say the 62 put, should it go up to the upside and hurt us up there, we increase our buying power in a heartbeat. We would be getting the credit for it, but the credit we would get is kind of marginal. Let's see how marginal it is. We'd get 60 cents of credit. That's, again, efficient markets. But with that 60 cents of credit, look at our buying power. Our buying power would definitely go up. Maybe not to the full 557, but in just getting 60 cents, we'd go from increasing our buying power, possibly not doubling it, but at least getting like 40% buying power to just get 60 more cents of credit should this thing go against us tomorrow. So it's not really like, the juice is not worth the squeeze on that one. So TLT so far looks like the only thing I'm looking at today. And again, markets change. So we want to get out of IWM and redeploy that later. Even though we got 53 days left, I already rolled it once. And if I have to roll something twice, it's not a trade meant to be had. I don't like to try to fix a car that's broken or that's totaled. Not to say the trade's totaled. It's still delta neutral. So he's still sitting at the top of the hill. It's just that he could be at the top of the hill, but what would happen is you get a volatility spike, which means all of a sudden he'll be knocked off that hill. And I don't want that because a volatility spike happens in elections. If we look at this, EWZ, we have, and that's another emerging market, that's Mexico, 56% on IV rank. IV index is 28%. It went up 2%. I like that. But let's see if the juice is worth the squeeze. Let's try to trade it. Again, I look at everything in terms of a strangle. And then I'll look at, if the strangle doesn't work, I start looking at directional plays in terms of, and again, I'm kind of being shy on directional because of an election. 21 deltas. We'll go to 16 deltas on this one. See if we can get down. That's 14. That's close to 16. 17, there's skewed a lot of, there's about the same amount of skew to the upside. So it's not really skewed too bad. You're only getting 43 cents for 285. That's not enough juice for the squeeze. Not enough at all. Because again, if I have to adjust it, then you're only going to get 10 cents more, but increase your buying power. Wait a minute. If that's 12 deltas now is moving. Market's moving on us. Yeah. So there's a 20. Okay. Nope. We'll get back to 15. So we're only getting 43 cents out of 285. So clearly the juice is not worth the squeeze. And it's possibly because the IV rank might be going down, or the IB index might be going down. This thing has the ability to move. They're saying they expect a $4 move, yet this thing can move. Okay, it can move $1 a day. They're saying they expect a $4 move before or between now and December 20th. That's what the expected move is, $4. So from 28 to 32, this thing could easily hit our short strikes because we're like just outside. Problem is, you're barely getting any volume. 4 contracts each side, 43 cents on that. If I had to adjust it, say the market went up against us, I'd adjust it. I'd only be getting 20 cents. It's efficient. 20 cents. I'd be paying 40 cents. Theoretical buying power would increase by 40 cents. I'd only be getting 20 cents should the market move against us. So the juice is not totally worth the squeeze on this. If we went and got the curve in and of itself, he's sitting at the top of the mountain, like I said, basically almost the same skew on this, because should the market get up there tomorrow, you'd be down theoretically $77, which is damn near 1/3 of your buying power. You're getting paid only 43 cents to lose 1/3 of your buying power should it go down. You'd be down 86 cents or $86 should it fall tomorrow. And if you were to move this, should it fall to that strike tomorrow, and you move this one strike, you'd only be getting like 17 cents, and you'd increase your buying power by 20 cents, by like 30 cents. So there's not enough juice in squeeze. And I could tell that just by looking at this. How much over that triangle is in comparison to your mountain, which is way, way underneath. So there's not enough juice and squeeze for this just by looking at the picture. So, so I'm going to sit on my hands. So we got IWM to close and TLT butterfly to open. And we'll see if that happens. Anything else that I want to get in? Let's see, Bank of America, where's that at? 44.29.23. Or, I mean, 2.3. I kind of like this. We'll see if that's a trade to get in. 44.29. Bank of America. Are we getting paid for it? Again, I look at everything in the context of a strangle. They got dividends right before then, so I'm not really freaking out. I mean, it's not something that you want to, because there is dividend risk if this thing spikes to the upside before then, but you're not wanting to hold this till the middle of December. Juice and squeeze, you're only getting 89 cents and 520 and 521. It's not enough juice and squeeze, even though it's paying you good in theta. It's paying you good in the probability of profit. You are losing a lot in gamma, which means this thing has the ability to move quite a bit. In other words, you're going to have to adjust. Look at that hill. A lot of skew to the upside. Should this thing go up there and get you out tomorrow, you'd be down $88 or $83, which is about a little less than 1/4, about 1/5 the buying power. If it goes down to the bottom, you'd be down around 70. So you'd be around a little bit less than 1/5 the buying power. Should this thing, again, juice and squeeze. Look at our hill and look at how close this thing, if this was up a little higher and our hill was a little bit higher, then I would, you're getting more juice and squeeze. So if you got into this trade and right now you got it 89 cents, if you wanted to only stay in for 2 weeks, let's back it up 2 weeks or 3 weeks. 3 weeks, you'd only be getting 50%. Okay, you get like 50% in those 3 weeks. Should you get into this trade? Oops. Between it was December 20th, so December 6th, that's 2 weeks. You'd only be down 20 cents. You'd be making 20 cents in 2 weeks. In other words, you make a third. You make 33%. No, you'd make less than 33%. You would make 25% in 2 weeks. But for the buying power, it's just a little too much for me on the juice and squeeze. I'd rather get more juice. There's not enough. Even though probability of 50% is 88, and you probability of making at least a penny or more 67, you're getting paid $2 a day. For me, it's just like I need more squeeze on this. If this swings up, like quite a bit more, I could see doing that strangle. That's Bank of America. That stock. Let me see what else is out there. Citigroup. What do we like on Citigroup? 43.31. Yeah, it's not the greatest. 43.31. That would be more like a condor if I did it. Because I really want to get some exposure to financials and not the XLF because I'm not getting enough juice and squeeze. Let's go here to our 18, closest to 16 deltas. This is going to be delta neutral. I like that. 142 is 688. You're not getting enough. Although the probability of profit and 50% are okay, they're very good. Delta's low, gamma's pretty high. You're getting paid $3.49 a day in theta. Am I willing to tie up 688? And that's just the strangle right there. You're going to have overnight margin too. So it could go, if it starts going against you, you're going to be paying a lot more in margin. That's one thing to be very, very cautious of when you're doing strangles because you're naked on these. So if we were to do this, we know point blank we're going to have to adjust. If we had to move this down, what does it do to buying power? It doesn't really mess up buying power too much. If we had to move this down, we're getting a little bit more credit, 40 cents. Buying power goes from 886. That's 865. Let's see back here. No, it goes up quite precipitously. It goes up damn near $200 in buying power just to move these strikes. Let's see what juice and squeeze looks like on the curve. Look at that, juice and squeeze. This is your juice. The straight line's your juice. The squeeze is the curve. Should it go down, you'd be down $163. Should it hit your strike on the upside. If it hit your deltas on the downside, 126, which means you would definitely wipe out all that buying power in a heartbeat. Even if you had to adjust, you would not be getting enough to it to make money to adjust it. You know, if this thing went down, and remember this thing, they're looking at this thing between now and expiration. They're saying this thing can move easily, move again about $8. So I'm saying $8 because I double. Oh no, they're saying $4 here. That between now and then it can move $4 on you. But this right here is telling me it moves at least $3. Again, that I'm saying I'm doubling the ATR to move $3. And it's already today alone, moving almost $2. So I'm saying this thing can move $3 a day. The average that it's moved $3 a day in the last 21 days is what I expect. It's already moved $2. So if it moved $2 on you, then you're looking at this trade again. I'm about selling premium. If it moves $2, it's already at 63, 65. You're already there in terms of you're off the mountain. Then you're already your theoreticals down in terms of your delta. You're already minus 13 deltas. Your deltas. I mean, you're already in terms of your theoretical, you're already down 13 deltas just for the movement there. So again, the juice is not worth the squeeze, and that's possibly because of this gamma. If this moves $2, that gamma is going to tear you up because that means it's moving. If this thing moves $1, your gamma's already down. You're down $7 already on this. So Bank of America. So I'm going to wait and see what happens with financials in the next couple of days. So the only two trades I see right now, and I'm going to come back to this later in the day, is getting out of IWM. Let's see. Getting out of IWM and redeploying it, get back in, when I get more volatility, because an election is going to give you that. And going down in price as markets kind of settle down. I'm going to go down from 12 cents to 11 cents to 10 cents. And that's as far as I'll go in TLT. I won't go anywhere more down to 10 cents because that's only $1, maybe $2 above the mid price. I'm trying to make the market come to me. That's what I want to see if it will. I'm not saying it will, but I'm going to see if it will come to me, which means it's up now $3.50. If it could come down, if not IWM, excuse me, TLT is up. No, it's actually down 7 cents. If it could come down another maybe 3 cents, I'll get filled on this, and I don't mind that if it comes down 3 cents because this trade I don't mind. So just giving you something that I'm looking at today are those two trades, and I'll see if markets settle down or they do something different later. Hey KW, good to see you. Good to see you. So if markets settle down, then I redeploy that capital, and in the other trades I'm not going anywhere. Those were all pretty much delta neutral. They're not moving, and then and then we'll get into some setting up for directional trades. Again, my grails, for lack of a better term, are set up for the directional plays are set up for when options have the most likely possibility to pin. You want things to pin because that means you pick the time and you pick the level just right. And I'll start getting into that a little later. In terms of buying volatility, we'll do that tomorrow because there's a trade that I might be putting on either later on today or tomorrow that is a calendar or a diagonal trade that you want to be out. And I got to thank Mark. Mark had a really good one over there on. Let me see if I could play it. He's got a really good one on a directional calendar. I'm not going to do exactly what he has, but I really like his his thought process. It's a trade that you get out by Friday. You would not be in this trade. Not to say, oops, not to say, but I do like the theory. Again, he's going diagonal with it because he's got an he's expecting markets to fall or at least not go up too much. But it has no risk to the upside and just a little bit of risk to the downside. I like his thought process because this is coming from he used to be with Sheridan Mentoring, but this
Hello again, everyone. Welcome to the Options Mentor. Now we're heading into the home stretch the last week before the U.S. election, which I expect will be a fairly market driving event. I think there could be a lot of tension and back and forth around that presidential election, which happens a week from this Tuesday. So what I'm wanting to do is be out of any of the what I call non-directional trades that I do, calendars, diagonals, flies, anything like that. I want to be out by this Friday. And I plan on the week of the election just doing speculatory plays. We can talk about some of that next Sunday. But that's what I will be doing. So I want to talk about a really short-term trade for this week. Hopefully be out. Well, you will be out by Friday because it's going to expire that day, but hopefully you'll be out before at a nice profit. So let me share my screen here. And here we sit. We do have the SPX just flirting around with these all-time highs. It was all the way up there. Now it's kind of backing off. The VIX is up to 20. You can really sense the tension, I think, in the market around these events. And not only that, this week we do have a very important inflation report coming out on Thursday. That's the PCE. That'll be an hour before the market opens. Also on Wednesday, an hour before the market opens, is the GDP. Both of those things can affect the market. I would expect the PCE would be more profound, though, on its effect. And then Friday, just to make it more fun, we have the non-farm payrolls, monthly jobs report, whatever you want to call it. That's also an hour before the market opens on Friday. So we really want to be out of things before Friday, if at all possible. So what I'm looking at here is I think with this ever hopeful market that will probably lean to the upside all week. So I'm going to do a call diagonal a little closer with the long than I normally do. A lot of times when I do a single call diagonal, I'll go down 20 or 30 points and buy the long. Well, here we closed at 58.08 and I'm modeling this here at 57.90, 57.95. So wherever we may be by midday tomorrow is probably when I would place a trade like this. I'm going to be looking, maybe buying that long 10, 15 points below we're trading, short 5 points above, I'll be selling. And the reason for that is we don't really have much in the way of risk on the upside. Yes, if it runs up, volatility can drop and affect us some. We definitely, although this shows like you could never lose on the upside, ultimately you can if volatility drops, which it normally would, if it goes up far enough. So I would suggest to you, if you get up in here and you got a profit 58.80 or so level, probably just take it. I mean, you could give it if it's really quick up there, maybe you could give it a day or two, but I would definitely take it if it was, say, Wednesday for sure, Thursday definitely. And so that's my idea for this week. So we'll have that extra room to the upside. This is sort of like a calendar with just a sidecar to it. So you got more room up here. Now on the downside, yes, we may have to adjust it or something if we get down around 57.40, but that gives us over 60 points of down room, which I'm comfortable with, unless something new acts on the market that really puts it in a bearish mood. But with this trade, I do think our best choice is to do a call diagonal where we have this extra room to the upside. And of course, by the way, if it just lays around here, we'll make our money on time decay. This thing expires Friday. Hopefully you'll be out of it by Wednesday or Thursday. And, if you have to take a lower profit, then maybe you normally go for 8 or 10%. Hey, take 5 or 6 if it's Wednesday. Maybe even less, depends on where you're at in the graph and what's going in the world. But definitely don't want to be in something like this the week of the election, which we won't be because it's expiring this Friday. And then next week, we'll talk a little bit about plays for direction or large moves that you can look at for election week. And I'm also going to, over the next week or two, try to add in some longer format videos here for you, a little more education. So hopefully next Sunday I
mean, I really like his thought process, because Sheridan Mentoring is more like they do a lot more buying volatility than selling it, whereas the Tasty guys they do more selling volatility than buy it. I mean, that's just different traders, different traders. I mean, I talked to Dan. I mean, him and Mark used to work together for the longest time, and I talked to Dan a couple of years ago, And I've known about Dan actually since 2003, because I think he was working at the SIBO. He was doing videos for the SIBO because I know he's a floor trader. And basically, these are debit spreads where you're going to have to pay to get in. But the thing is you could still get your percentage profit. It's just that I'm not as directional for this Friday. I don't want to take a trade just for this Friday that's directional. Only because anything can be happening in the next few days. That is, and I don't want to tie up $700-800 worth of buying power on that kind of a play. I'm more conservative. On a possibility that, some folks can do it. $700-800, you make your $70-80. That's 10% and get out. But if I'm going for 5 or 6%, I would rather something I can adjust a lot easier, like a strangle, than having to put more money. It's like putting good money after bad on a calendar. Because again, those are debit spreads. So you have to pay. They're a lot harder to adjust. Every time that it goes against you, you have to put something more money in the pot. And that, instead of saying, look, I would rather adjust it with something I can get credit with, which is, selling volatility. So everybody's got their different things, that's just the nature of the game. But anyways, I just wanted to give you this heads up. Hopefully this worked for you. That's what I'm looking at today, those 2 trades. The other ones didn't pan out, but I did keep some on the wheelhouse, that just in case. The GDX was just not paying me enough that I really would want to do it. But some of the other trades I'm going to keep in there as a just in case scenario, just to see if I want to later on today see where markets move today. If they kind of resettle, because right now they're on a tear. They're still going in the one direction. But should they want to resettle before, before mid-afternoon, I may take another look at those and put those other trades on, the ones that are in the wheelhouse. Outside of that, we'll see what happens. Anyways, Brother Will, KW, Hotep.